Good morning, everyone, and welcome back to this KTI Ideas for Your ISA event. Shortly, we'll be hearing from Prashant Khemka, who'll be talking to us about Ashoka India Equity. Ashoka is the top performing India trust since its launch. It's fair to say the Indian market had an excellent 2021 despite the tragic impact of the pandemic. And while markets have been down in 2022, it's actually been a relative bright spot, holding up pretty well versus the emerging market index. Unfortunately, having briefly traded on a discount during the volatility, AIE is now back on a small premium. So Prashant will speak to us for around 25 to 30 minutes, and then we have time for questions. You should see a box to the right of your screen where you can put your questions through. I will collate those and put those to Prashant at the end. So with that, I will hand over to you, Prashant.
Thank you, Thomas, and thank you everyone for joining us today. We will, in the next 30 minutes, cover some of the prepared slides and then very much look forward to some questions from you. Briefly about White Oak. While the trust is now grown very nicely over the last 3-4 years and is about 200 million or just under 200 million pounds, overall as a firm, we do manage and advise $5.5 billion. The total headcount firm-wide is now over 200 people, including a lot of them in India for distribution in India, but now more than a dozen people in a Singapore office as well. Overall, the AUM mix is about 75% from outside India, 25% from within India. As you can see in the bottom right-hand side graph, roughly 40% comes from institutions, 45+% comes from individuals, mostly high net worth and family offices, but also through private banks and wealth managers. The greater tilt to offshore is to do with my background. Since many of you I have met before, not to give an extensive background, but I grew up in Bombay, started investing in Indian markets as a retail investor in 1985 when the markets were up 100%, the best year since then. Went to study abroad to the US, worked there at State Street Global Advisors and Goldman Sachs Asset Management, combined together for 8 years on developed world equities, came back to India to start Goldman Sachs Asset Management, which I led till I left in 2017. Along the way, was also made CIO of Global Emerging Markets in 2013, managed both India and GEM from 2013 to 2017 when I started White Oak. So now we have coming up to 5 years track record at White Oak, and prior to that 10 years of managing money professionally in India, track record at Goldman. Very happy to say during almost every multi-year trailing time period, performance has been top of the peer group, and we'll share some of the AIE performance or Ashoka Trust performance in a short while. Now, always I give this caveat that while we will be talking considerable amount about the macro, macro hardly has any influence, if at all, on how we generate alpha. Macro is more a source of risk, according to us, that ought to be mitigated so that the portfolio performance does not get hijacked by macro developments. And we remain as a team always focused on bottom-up stock selection through opportunities. India, in my view, is the most compelling market for alpha seekers. And that is the alpha opportunity is the most compelling reason to invest in India. The macro story may be good. Some may think it's good. Some may think it's not good. But what is really most compelling is, and we don't have a strong view on the macro story. We provide our version, which I'll share with you in a few minutes. But the most compelling reason in India, the market provides the potential and opportunity that the alpha can be a bigger component of total return than the market return. And the market return is healthy also, by the way. Over the last 20 years, dollar term returns has been just above the US markets. US markets have delivered 5% in dollar terms. Indian markets have delivered 6% in dollar terms. But the potential for alpha, as you can see, this is a study published by Wall Street Journal, now a couple of years old, but not much has changed. US and developed world and even some of the developing was the potential for alpha is very small, relatively small or negative, whereas a few markets that have consistently shown to deliver higher alpha, and India is at the top of the pack. So when you look at total return, um, and this is the average, by the way, average manager. Obviously, if you are able to identify top ranking or top decile managers, then in terms of total return, India has the potential to deliver lot higher than most other uh, markets in our view. The long-term case for Indian equities, many of you would have heard from me several times, but I think with what's going on globally right now, it reinforces, um, some crucial points here that often people would gloss over. And I'll come to that, which is more at the bottom of the four points that we mentioned here. But economic evolution, it is once in an era transformation that India is going through, a multi-generational opportunity. Currently, it's the sixth largest economy. By the end of the decade, it's expected to more than double to third largest economy. It's domestically driven growth, unlike many other Asian peers, which are export dependent. Domestic consumption is nearly 60% of GDP. More so than any other market, in my view, India has a very profitable and diverse corporate universe, entrepreneurially driven corporate universe, as government owned entities are one of the smallest segment of the market compared to elsewhere in the most of the other developed world, and most pertinent in current times. And these occasions come, every once in a while, when this fourth point becomes most important point to stress on. It is, by the way, something that we've had for even at Goldman pretty much at the beginning. So last 15 years, I've talked about this aspect, that more so than most other emerging markets, India has one of the strongest institutional infrastructure of a mature democracy. And when it comes to the core elements of democracy, right? Not necessarily some of the nuances, but the core elements and principles of democracy, India is not much different. In my view, I would say it's as vibrant a democracy as any of the Western democracies. These are far-reaching implications. India has independent institutions. There's strong separation of powers, which I'll cover in the next slide. And all those separation of powers mean strong property rights under a common law system, which is one of the best things that India inherited when British left back in 1947. Besides what is generally thought to be the English language and the game of cricket, obviously, which is an Indian game invented by the British, as we like to say. Now, so this is the soft infrastructure. The physical infrastructure is there for everyone to say and notice. And that's what people usually get preoccupied by when they visit India and look at the poor state of infrastructure. That should be viewed more as an opportunity. That is why, and that is that in physical infrastructure is commensurate with a $2,000 per capita economy or thereabouts, right? If physical infrastructure was as good as Japan or Switzerland or UK, India would not be an emerging market. India would be multi tens of thousands of dollars of per capita income. But when it comes to soft infrastructure, which is the institutional infrastructure that I talked about in the prior slide, India is far more developed, and that infrastructure is more commensurate with, countries with far higher standards of living. Most important in that is the separation of powers, which leads to these independent institutions like judiciary, central bank, election commission. We should add here the military. There's only so much control that, and this is all in the constitution, right? And it's not merely in the constitution, it has been followed now for many decades. It's been enforced and implemented properly for many decades, and that all those leads to very strong protection of property rights. So the events that we've seen over the last, obviously the geopolitical issues that are playing out between Russia and Ukraine, but even last year and the year before, some of the authoritarian regimes across GEM, some of the problems with where investors have had to suffer heavy losses, partly they were, in great part, I would say, not partly, in great part, they were due to poor protection of property rights for corporate sector and minority shareholders. So, as you can see, in terms of separation of powers, India ranks very highly right after Taiwan at 9. At the other end is, China is 1, Saudi is 1, and few other countries that I hope you can read here. Russia is 3. And this is the from the index of Bertelsmann Stiftung from 2020, widely followed for this purpose. On the right side, you see the net democracy score. Again, tends to be highly correlated with the separation of powers. And not surprising, Taiwan and India are at the top end, and the same countries are towards the bottom end. And some of them are going to fall down further after the developments of this year and the last year, as this is data that's not, I think, been refreshed so far for 21. So very, very crucial. And this is what is playing out right now, where you see that, some of the markets have come under very high, selling pressure, and have been have eroded considerable amount of wealth for investors. Now, the separation of powers and democracy has led to higher stability in India. Hence, you see, despite, again repeating, that from a per capita income standard of living perspective, India is farther behind most of the emerging markets. But because of the strong soft infrastructure, when it comes to stability, it has higher stability, displayed higher economic stability than many others who are well ahead in terms of standard of living in the emerging market. So there are several countries here listed. You can see from LATAM to Asian countries to European countries who have suffered currency crisis or debt crisis or political crises over the last several decades. Russia needs to be updated now for 2022, which next session we would. But you don't see India up here because we haven't had such situations in the past, and the reason is the strong institutional infrastructure that I mentioned. The level of, so when you look at the multiples, which we'll also look at in a short while, people often find the multiple of certain countries, including India, to be higher than the average of GEM or elsewhere. And that is one of the key reasons is this soft infrastructure that I talked about. Think of this separation of powers and democracy and rule of law. These are like corporate governance. When you're investing in companies, individual companies, you look at the mix of board of directors, the independence of board of directors, the other, related party transactions and various other things, right? Auditors and all those kind of things. They constitute corporate governance for a company. And just like in any market, in any sector, a company with strong corporate governance trades at a big premium to companies, all else equal, with poor corporate governance. Similarly, you would expect that with countries as well. And hence, what you see a basket here is that a basket of more democratic countries have historically always traded at a premium to a basket of less democratic countries. And this scoring of more and less democratic is from the Polity project database from the US, which again is widely followed for this purpose. Let's move on now, and happy to answer questions on that front, but move on to the earnings trajectory of the Indian market in recent time and what's being projected and valuation. So you'll see over the last 35 or nearly 30 years, consistent with what you would think logically, nominal GDP growth rate has been or corporate Indian market returns has been similar to the corporate EPS growth, and has been similar to nominal GDP growth rate, is about 12 to 12.5%. Obviously, it's not come in a straight line, and it's in local currency terms. So if you convert to USD, you should assume, roughly speaking, about 3.5 even 4%, depending on which time frame you're looking at. But over longer time frames, 3.5 to 4% hit due to currency. Uh, Obviously, it's not come in a straight line. There have been periods of, as you can see, the early 90s, 40+% growth, followed by 7 years of 1% growth, followed by 25% 5-year growth, and then a long lull of nearly of over a decade, only mid-single digit growth. And then over the last couple of years, we've seen an acceleration to 20+% growth. And this is, largely following the profit cycle. As you can see, the profit cycle in the early to mid 90s were declining, and then there was sharp jump and then long gradual decline, and now it's reverting back to the mean. And hence but over this time, the average ROE for India has been more robust than the comparable peer group. More recent times, you'll see that the earnings growth, if you look at the bottom left hand side, last year, the year of the pandemic ending March 21, was up 14%, which was the strongest growth in nearly 10 years. This year is expected to be more than 30% growth, which would be the strongest year in the last 18 years. And then expected to still sustain some robustness in growth, because this year also has been COVID impacted demand. Because if you remember, the Delta wave, the second wave, fell in the current fiscal year. So expectation is we would, over the next couple of years, have mid to high teens growth as well. Besides strong growth, not only India's earnings growth has been strong, India's had one of the most stable, relatively stable earnings growth profile over the years compared to other EMs. This reason for strong earnings growth over the last few years, last couple of years particularly, there are several factors supporting that earnings acceleration. First of all, post-COVID, the market shares got consolidated to a greater degree in favor of larger, more established players compared to mom and pops. And obviously, the listed companies are, and when I say large, I don't mean large caps. What I mean is organized sector compared to the unorganized sector, which is fairly large in India. As an example, in case of jewelry, right? Nearly 90% of jewelry sales in India, call it 80 to 90% of jewelry sales in India, are in the unorganized sector, mom and pop stores. So Titan Industries, one of the companies we own in the trust, Titan is the largest organized player. They've been able to gain market share. They've been gaining market share for donkey's years, for decades now. Pandemic provided means to accelerate their market share gain for a variety of reasons we can go through in Q&A if there's any interest. But as a result, they've grown nearly 30% compounded over the last 2 years. They've been growing anyways in 20% compounded for a long period of time, but through the pandemic, they've further accelerated their market share gain. Second very strong phenomenon that's further expected to pick up now post Russia's invasion of Ukraine is the China plus one phenomenon. This started maybe 5-7 years ago in more earnestness, uh, picked up further post Trump, as the rhetoric and many of the actions that the Trump government was taking against tariff and non-tariff actions against China. It became evident that corporations, large corporations, can no longer have their entire supply chain dependent on China. And now it's been further, then it got further boost due to the pandemic, and now we expect it will be further accelerated due to these invasion that we just talked about, because companies and boardrooms increasingly becoming wary of uh, very high dependence on any one jurisdiction, because of not only geopolitical risks but also sanctions that could at any point become applicable. If you have all your eggs in one basket, it would pose very high risk. So several sectors have been beneficiaries. Over the last few years, the trust has benefited considerably in areas such as specialty chemicals, electronics, and other manufacturing in general, and we expect this trend to accelerate going forward. Surge in global technology spending, as you can see right now, the way we are communicating, it's the benefit or the outcome byproduct of the pandemic. It has, and many other such developments have accelerated the global technology spend. In India, technology is a very high, large segment of the market, so they're definitely a benefit. It's all IT services, and it is benefiting very robustly. And then the other factors, the increase in commodity prices has also, while commodity is a small sector in India, but they've gone from negative earnings to very strong earnings, so that's also contributed. When it comes to valuation, the multiples are about in line on PE multiples, if you see on the left hand side, are about in line with the Modi era multiple, if you will. So from 2014, since Modi came about 8 years ago, the multiple has averaged around 21. And we are right now right around that after the recent pullback due to the invasion. It is compared to the very long term 30-year average, it's at a premium of about 15 to 20%, but everything around the world, including US, is at a premium to the 20-year year average, and that's probably reasonably so. Again, we don't have a strong view on this, but given where the interest rate environment is. Price to book multiple, you'll see, is at a bit of a premium compared to the long-term average, but again, closer to the Modi era multiple. So what are the risks? So the key risks near term is sharp reversal in global markets for any reason, including geopolitical. So in the short term, markets are fairly highly correlated. Though year to date, India's, as Thomas was mentioning, held up much better compared to other EMs or even developed markets like US and Europe. The unknown, still there is lingering risk related to COVID. If there is any kind of variant, again, it could be global or could be more India specific. Those risks are still there. Any further sharp spike and sustained level of oil prices at sharply higher oil prices also continues to pose a risk, though it is not something new and it is often overblown in terms of its importance for India. So before we delve into any of this risk, important lessons from 2020, right? Because now we'll talk about oil price increase and what it means for India and all that, and what it means for GDP growth and whatnot. We believe the best lesson, I mean, the most important lessons from COVID were pertain to the futility of predicting investment returns based on macroeconomic worries and events. The first lesson was the usual perennial macroeconomic worries of the well-known unknown varieties are a colossal waste of time. Like what will be inflation, what will be GDP growth, whether a percentage point higher, lower, they do not, or if at all, they hardly influence the future returns from equity markets, if any at all. Because remember, in India, pre-pandemic, in early 2020, 2 years ago, the expected GDP growth rate was 5%. And people were wondering whether it can accelerate to 6. What would it be like if it goes down to 4%? What would be the impact on the markets? The actual GDP growth was minus 7.5%, a delta of 12.5% in a year, and the markets had one of their best years, up 35%. You don't need any better evidence than this to understand what we're trying to say here, which is that such perennial, usual macroeconomic worries of the well-known unknown variety are a colossal waste of time in terms of trying to predict the implications for investment returns. Lesson two, nobody has a crystal ball, first of all, to forecast cataclysmic risk events. But even if you had one and you knew perfectly well what is going to happen in the pandemic, the market implications would have remained unpredictable. Because anyone who knew in February that this would be the extent of damage this pandemic is going to cause to the world would have exited the market, Indian market, and markets elsewhere. And as I said, it was one of the best time. So the biggest lesson, lesson number 3, is that investment decisions bereft of bottom-up analysis and instead driven by macro considerations are fraught with higher risk of substantial, absolute, and relative losses. I would love to remind that the day Indian markets bottomed on March 23rd, 2020, there were in total, cumulatively, not that day, but cumulatively only 5 deaths in India because of COVID. That infection case count that day was 75 only, not 75,000 or 750,000, but 75 cases that day, right? And markets bottomed then. And all of us know later on there have been millions of deaths, and the markets have done extremely well through that. So knowing these kind of macro events doesn't help even if you had a crystal ball, doesn't help in generating returns. So that's the perspective that White Oak has on these macro events, that the value of the market at any time is present value of aggregate perpetual future cash flows, and that the market is fairly valued at all times. In aggregate, obviously stock specific, there are undervaluation and overvaluation. The relevance of macro is as a source of risk. We see it as source of risk, not as an opportunity to add alpha. We consciously avoid top-down misadventures like market timing, sector rotation, and so on. We stay fully invested with a bottom-up approach and maintain balanced portfolio at all times. Now, if we come to the Russian invasion of, a lot of people have asked me, particularly from outside India, why hasn't India criticized Russia and did not and abstained from the UN Security Council resolution deploring the Russia's aggression? Regardless of what I feel personally, and very much deplore in today's day and age, any aggression towards any country when it is so unwarranted. However, one has to understand what India's perspective, why India has chosen to do what it is. Besides what is listed here, remember growing up as a kid, my father would always tell me the story of how in 1971, the year that I was born, when we had a war with Pakistan, when America had sent some of their frigates, so naval ships, to Indian Ocean as a threat to India. It was Russia who sent its submarines at the right time to stand against the American naval ships. So back then, 50 years ago, we didn't have the military equipment to or the wherewithal or the capability to stand up against Pakistan supported by America, right? So when you grow up as a kid and listening these things, you end up supporting in your mind. So that's what case was with me in 80s and even till this Afghan or the Soviet pulled out from the Afghanistan. America was considered a friend of Pakistan, and Russia was considered a friend of India. So in Olympics and all, because India didn't have a strong, quadrant to send to the Olympics and win medals, most Indians would support Russia against America and those. So that is the background I want to provide. So it's not so easy for India to, at UN, vote against Russia when Russia is consistently, even after those 80s and 70s and 90s, has been in support of India on various crucial issues at United Nations. We have abstained, which itself, I think, is what India could have done at most. I mean, regardless of what individuals like myself might think. We have a lot of dependence for our military equipment. Still, 70% of our military equipment is designed or made in Russia and would continue to serve us for at least next 2 decades. Some of the most crucial elements like T-90 tanks and the BrahMos missiles, which are supersonic cruise missiles, they are a product of either Russia or joint ventures between India and Russia, and we continue to critically depend for a lot of supplies, spare parts and supplies from Russia. So when you have neighbors like Pakistan and China, we cannot afford to alienate a long-standing supplier of arms and equipment to the country. So just something that it's a question that's come to me several times, particularly from UK. So I wanted to spend a minute or two on that one. Rising crude oil prices reminds me some of deja vu. 4 years ago or close to 4 years ago when we launched our IPO of the trust, oil prices peaked for that year in 2018 to about $90. And the entire IPO roadshow was hijacked by this single issue. And hence we only could raise 46 million pounds, much lower, if not less than half of what we would have anticipated for this single reason, oil price. I think it's way overblown. India's dependence on oil price is way lower than it was in the past. As you can see in the dark blue line over here, as a percentage of GDP, it was a lot higher in years gone. And today, as a percent of GDP, is much lower, even if the oil price has doubled over the last year. Last year, obviously, was very low oil prices because of the pandemic. But even compared to, say, 17, 18, 19, yes, the oil bill would be higher, but as a percentage of GDP, it's gone from about 2.5% to 3% or something like that. It's very absorbable in light of the strong export growth that we've seen over the years. This is not a concern. There's about various estimates out there between 25 to 50 basis points impact. Let's call it about 50 basis points impact for every $10 of oil price increase, sustained oil price increase on CPI, on current account deficit, and on fiscal deficit. But it's a function of various actions that are taken by the. All these are not taken for are not set in stone. Depending on various other aspects, these could be much lower than what is mentioned here, or somewhat higher as well. Market inflows, India has seen fairly muted inflows from foreign investors, mostly because of GEM and multi-regional flows. But domestic inflows have been robust, as well as foreign direct investment has been robust, even if not in the stock market. But as foreign institutional investors, we've already seen year to date the worst outflows since recorded history from the Indian market. The full year, we've exceeded full year outflow already in the first 2 months compared to any other year before. And still, the market is one of the best performing globally amongst developed and emerging. Just moving to Ashoka India Equity Trust in quick, it's a zero fixed management fee. Only performance fee is linked to alpha, not to absolute performance, but it's a 30% of alpha once an alpha after accounting for the fund expenses. You'll see past performance has been very strong since inception. Annualized or cumulative, you'll see 83.1% return compared to 36% for a 47% alpha since the fund became invested at the end of July 2018. Very importantly, market cap attribution shows from a market cap attribution perspective, all of the alpha and more has come from stock selection. So overall 75% alpha, of which 93 has come from stock selection, and allocation effect is minus 18. When you see sectorally, again, out of 75%, 77% has come from stock selection. And again, in each and every market cap segment and in each and every sector, it has been positive. Top 5 contributors and detractors, very well distributed. So law of large numbers well at work, and detractors are far smaller in terms of hit compared to contributors. Relative to competitors, you'll see each and every year, the dark green shows the best performance and the dark red shows the worst performance. Ashoka India Equity compared to our three other listed peers, in almost each, in fact, year to date, we are second, but there's a long way to go for the year. But each and every other prior period, we've been clear leader on both NAV and share price. And by a huge margin, as you can see, since inception at the top, NAV performance for us is 71% ahead, higher than the peer group, and 47% higher than the benchmark, because the peer group has underperformed the benchmark. And even share price performance similarly has been higher. As a result of this and the construct of the trust, we have generally traded at a small premium compared to the big discount that the peers have traded. Our liquidity has gone up manifold. We have grown multifold. We more than quadrupled over the last 4 years as of today, whereas peers have been flattish over this time. And liquidity, we are one of the most liquid now, and now we've also been included in the FTSE All Share Index. So I'll stop at that. There is more stuff here that I haven't covered in my prepared comments, but would spare that for Q&A if there is. Thomas, over to you.
Certainly. Yeah, thanks, Prashant. Yeah, there's definitely been plenty of questions, but there's still time if you're in the audience to put your question through, so please do. Prashant, you discussed and you explained very well the reasons for India's neutral stance with regards to the current conflict. There have been a couple of questions, though, about whether you think there'll be any significant impact on the market. So perhaps in terms of a backlash from foreign investors, is it a potential problem for the China Plus One theme? Are there any signs that foreign companies are reducing their interest in investing in India as a result.
So, if I understand right, is a question that foreign companies have reduced interest in investing in India because India did not deplore Russia or has not aggressively come out against Russia?
Yeah, I think there's a couple of questions. That, in a broad sense, are there any implications from this politically? And in terms of the China plus one, is there a fear that India becomes less attractive as an alternative to China?
No, I think it is huge. I mean, forget about the political and geopolitical, whether it's good, bad. I mean, but this is hugely positive for India. And everything we are hearing from companies, corporates, um, domestic companies, or to the extent we've spoken to companies outside India, it's a big positive because you don't see in the normal discourse. If you read Bloomberg headlines or whatever, you don't see the world, the developed world, like say UK or US, pushing hard on India to come out strongly against Russia or anything, as they're doing with China, let's say, for example. And there's several reasons for that. One is that, again, not to I'm not an expert on that, but nobody's blaming India to have known of the attack beforehand, as they're blaming, let's say, China. Nobody's blaming India, or doubting that India would provide military support to Russia. Maybe we are not, equipped to provide, but no, that those kind of questions are not being alleged at India. And US and UK and all, they understand, our military compulsions, our defense compulsions, and that's why, besides what is perfunctory and generic requests for India to come out more strongly, nothing has been said against India. And clearly, we haven't heard anything but the positive impact for corporate sector as things stand today from corporates when it comes to the China plus one impact.
And after the sort of recent sell-off, I think the market's down 8 or 9% year to date. There's a question about where you're currently seeing the greatest opportunities. I think last year we saw a very strong run up for mid caps as well, smaller mid caps. Could you perhaps discuss where the best opportunities are at the moment?
Certainly. So as we said, we don't take top-down thematic views, but from a bottom-up perspective, and given what our investment philosophy is, we tend to find more attractive opportunities in certain sectors which have large number of well-governed, better governed companies. Just the construct of the sector at sometimes. And similar is the case right now. Financials, IT services, consumer remain. And while it shows materials as well as fairly high, but remember, paints companies, so decorative paint companies get classified as materials because they're chemicals, treated as chemicals, but they're more consumer staples. So, but those are the areas we continue to see very strong opportunities. And within materials, obviously, there's a lot of chemical companies besides the paint companies, but there are pure play chemical companies that we own as well, which are there. These areas continue to remain very well represented in the portfolio, besides companies in healthcare and staples as well. We've almost always struggled to find anything attractive given the construct of the Indian market in energy and utilities, which tend to be heavily dominated in terms of number of companies, at least by government-owned companies, which we traditionally have not invested in much, if at all. And in large, mid, small, you'll see here we remain about, which you'll consistently find about 50% in large cap, and as of now, 50% in mid and small cap put together. And I think investors should expect more or less over time with plus or minus 10% in similar range. We never make a call that large caps would underperform or mid caps would underperform going forward. It's just alpha opportunity is much, much larger in mid and small cap. So what you see here is over the last 4 years, if you look at the middle gray column, it shows that in the benchmark, 81% is in large cap, 14% is in mid cap, 6% in small cap. We've had much higher, 23 in mid cap, 24 in small cap, and 48 in large cap. You look at the return differential, right? In the benchmark, large cap has delivered 45% return, mid cap 30% return, and small caps negative as per fact set criteria, right? Whereas if you look at our portfolio returns, while in each category we've delivered top of the peer group. So if large cap was a separately run fund, it would be the best large cap fund, delivering 75% compared to 45% return, nearly a high single digit alpha. Mid cap is 182% return in the portfolio, and small cap is 190% return in the portfolio. So it does not matter that in the benchmark, mid and small cap underperformed the large cap return. What has really mattered is that for our portfolio, the mid and small cap has done way better than the large cap performance in the benchmark also, which is, very, way better, and obviously also done better than the large cap performance of our own portfolio as well. And it is due to the huge alpha opportunity that exists in these segments. Just because alpha opportunity exists does not mean you can capture alpha opportunity. Obviously, so our team has done a phenomenal job, because there are other funds in India and abroad which are mid cap focused funds or mid and small cap focused funds, and they've had a very difficult time over the last 3-4 years, many of them underperforming despite being focused on mid and small cap, including one of the trust vehicles out, which is included in this peer group.
You mentioned corporate governance a few times. There's been a question about how you spot frauds and similar issues in companies. Is that a particular problem in, with 50% in small and mid caps? Is that a particular issue you need to take account of, and how do you approach that?
Certainly. Unfortunately, I don't have the slide that explains that over here, but I will still try and explain. So this is a question I've got since long. First of all, you mentioned small and mid cap, but people ask whether, investing in India, what about corporate governance problems? In general, emerging markets, high corporate governance problems. In India, has high corporate governance problems, though this, that, and the other. Oh, again, a slide I don't have or have excluded since the last time, I believe, is the minority protection. I don't think I have it in here, but for minority protection, India ranks one of the highest in the world. So there are laws, regulations, and all which are far superior than even developed world countries. And that, if you guys recollect, we would have gone through that in the November presentation for those who attended the November presentation. But those notwithstanding, see, even in my best corporate governance lessons I learned while investing in the US, particularly when I was covering telecom media sector at the peak of the TMT bubble in 2000. So I covered WorldComs and Quest and Global Crossings and all those. And those have served us as a team in very good stead. And we have a forensic expert on the team, individual dedicated. Besides, I would say each and every individual is an expert in these matters, but a particular individual dedicated, Aman Kapadia, and he's got background in investigative journalism for corporate governance. But we think of corporate governance in misgovernance in 5 categories: cheating existing partners, where companies are siphoning money or value from the company through related party transactions or otherwise; cheating investors at large, where you have stock prices getting manipulated; misalignment of interest, like government owned companies; fourth is unethical business practices, where the business itself depends on practices that you would not want to encourage, unethical practices, immoral practices, if you will; and fifth, aggressive or poor accounting. Now, each one of these have to be addressed in different ways. Just in the interest of time, given the format, might not be able to go through them. But key reason why our performance is as strong as I shared earlier, particularly in years like 2018 and 2019, when anyone who had corporate governance problem, any company who had corporate governance problems got taken to the cleaners, and fund managers who had such companies in their portfolio lost massively. And we were the best performing fund in 2018 amongst the local peer, domestic or even global peer group of flexi cap or multi-cap funds. And that is testimony to the team having successfully avoided each one of these governance disasters. So mid and small caps present the best of the, within mid and small caps, there are certain companies which have the best corporate governance anywhere in the world. Okay. And at the same time, you will have worst governance as well. You'll make, if you just throw them all out, you throw the baby with the bathwater, you miss opportunities as well. So you miss landmines, but you miss opportunities as well. If you can identify the difference between the two, if you can distinguish between the two, you can generate huge returns. And that is what our team has very successfully managed to do. And I'm happy to talk more at length on a different format. This is a topic that I can go on for hours.
Yeah. Yeah, unfortunately, we are running out of time, but I'm going to cheekily try and sneak in a final question. There's been a few questions around interest rates. So if I could try and tie them all together, maybe you could give us a brief view. So with inflation being so high globally, do you expect the Indian central bank to have to raise rates? What kind of effect might this have on corporate financing and on domestic investors?
It is definitely, Thomas, while relevant question from a global perspective, it's definitely not in my top 10 or top 20 worries for India. Okay. And never has been, nor is it today. There is very, very, very little evidence. In fact, I would say there is no evidence to support the argument that central bank raising rates leads to underperformance in markets. And this, I did not have it in the main slide deck because this was done for US, and I've asked the team to do it for India as well. Maybe the answer is different, but I would be surprised if it is. In the US, 8 out of 8 times that the Fed has increased rates, from the first rate increase, the market has delivered positive returns over the next following 12 months. And not just positive, it's returned 10.8% returns, well above the average return of mid to high single digits of about 6 odd percent, nearly twice as much return from the first Fed increase, right? So I think people universally take it for granted that central bank rate increases are negative for the market, but there is no evidence whatsoever that I've seen. And I'm happy to stand corrected if anyone has that evidence that supports that. In fact, the evidence that I'm sharing here is to the exact contrary. I do not believe that I think this is just statistical coincidence, and it's not something that one can make money out of going forward, because in all such cases, I think that there is no predictive power of any such macro factor when it comes to future returns. Because PhDs from MIT and Harvard and Stanford for donkey's years have been doing these back tests going back hundreds of years to see if there's any predictive power on any of these. And I have worked at State Street Global Advisors for a while in their quant side, and I myself did thousands of such back tests. There's no predictive power in any of these. It's just historical, fact. And here, at least what you see is the historical fact does not support the intuitive, anecdotal viewpoint that people have.
Thanks, Prashant. That's certainly provoked some strong opinions in the questions, but I'm afraid we really have run out of time, and I apologise to those who asked the 2 questions that we didn't get to. But if you pass those on to us, we'll try to put those through to Prashant via email. Thanks very much, Prashant, for your time. Thanks for the presentation. Thanks to the audience for your participation, and we hope we'll see you at the next session.
Thank you, Thomas. Thank you, everyone, for joining and for the questions. Appreciate it.